All right, let's set the scene. Picture this. It's right after the 2008 financial crisis. The dust is still settling, and regulators are, they're on a mission. They're going to the biggest banks in the world with a pretty straightforward demand. Prove to us this won't happen again. So this is the story of how one of the biggest banks on the planet tried to answer that question and failed spectacularly. So, Bank of America puts together this critical survival plan and hands it over to the Fed. This thing is their blueprint for stability, their big promise that they can handle any storm that comes their way. And the regulators, they take one look at this incredibly detailed document and stamp it with a giant red rejected. Just flat out no.
Now you have to understand, this wasn't just some homework assignment. This was their living will. Think of it like a prepackaged emergency plan for a financial giant. It's supposed to show exactly how the bank can be taken apart safely in a disaster without dragging the entire global economy down with it. So for that to get rejected, that's not just a bad grade, that is a huge red flag for the entire system.
So the big question is, why? I mean, was it a money problem? Did they not have enough capital? Were their financial models all wrong? Well, the crazy part is, it wasn't about the money at all. The problem was a total lack of information. The bank literally couldn't see itself clearly.
It all came down to this one deceptively simple question from the regulators. A question that, when you think about it, sounds almost absurd to ask a bank this size. They just asked, where is your cash right now? And the devastating truth was they couldn't give a confident answer. Not instantly, not with certainty, and in a crisis, certainty is the only thing that matters.
So what was the real culprit here? It wasn't some shady trading strategy or a bunch of bad loans. Nope, the real failure was buried deep inside the bank's technology. The problem was its databases. The very digital foundation of this massive institution was, well, it was a house divided against itself.
Okay, so let's break it down. The problem started with their treasury systems. This is the department that manages the bank's own money, its own assets. But this whole system was basically operating on an island, a data silo, with its own rules, its own formats, completely cut off. Then you've got another island, a totally separate system holding all the crucial liquidity data. Now this is the information about the actual cash they have on hand to pay the bills, which is, kind of important in a crisis. But this database couldn't really talk to the treasury system. It was just another disconnected piece of the puzzle. And it gets worse. You had the risk management systems in yet another silo. So every division had its own version of the truth, all stored in these different incompatible databases. This whole setup made it completely impossible to get one single reliable picture of the bank's own money at any given time.
And miss right here, this is the heart of the problem. On one side, you have the bank's reality, this chaotic mess of fragmented, unreliable data. And on the other side, you have what the regulators needed, a single, unified, instantly verifiable view of their cash. The massive gap between those two worlds is exactly why they failed.
The fallout from this was huge. I mean, forget the public embarrassment for a second. The bank was now under incredible pressure from regulators. They weren't just told to go back and rewrite a report. They were ordered to fundamentally rebuild their technology from the ground up to create a single source of truth. And the price tag for that kind of clarity? It was going to be enormous.
So what does a rebuild like that even look like? Well, it was a colossal job. First, they had to go on a scavenger hunt, basically, identifying every single place data was being stored. Then, they had to design a completely new, unified architecture. After that, the really hard part, painstakingly integrating all those separate systems. The whole point of all this effort? To create what's known in the industry as a golden source of truth. One database, one system that provides one clear, trusted answer. This whole episode caused a fundamental shift for the entire financial industry. All of a sudden, being compliant wasn't just about having the right policies written down in a binder somewhere. Real compliance, real strength, was now about the architecture of your databases. The technology itself became the foundation of trust. And the lesson learned here went way beyond just this one bank. This whole ordeal completely rewrote the rulebook on what it means to be resilient in the financial world. It proved that a bank's foundation isn't just built on capital anymore. It's built on data. And if that data foundation has cracks in it, the whole building is at risk of collapse.
So let's boil it all down. The key takeaways here are pretty stark. A bank's survival now depends just as much on its databases as it does on its cash. Having your data all over the place creates massive blind spots to risk. Regulators are done with ambiguity. They demand a single source of truth. And, at the end of the day, true resilience, real strength, is built on an integrated technology foundation.
Which really leaves us with a final critical thought, and this applies way beyond Wall Street. In a world that is so completely built on data, from our finances to our healthcare to our own digital lives, how solid is your foundation? Can you really trust the information you rely on when things get tough?